Okay. Now let's try to understand days payable outstanding, which is like how many days you take to pay your suppliers. So days payable outstanding is like you need to take average accounts payable divided by cost of goods sold, and which needs to be divided by 365. It's just like the reverse of accounts payable turnover ratio, wherein it was cost of goods sold divided by average accounts payable. If in the reverse, you can see average accounts payable divided by cost of goods sold, and then to calculate the number of days, you divide the cost of goods sold by 365. So let's go and try to see these numbers into our financials. So if we go above and see our financials, so our cost of goods sold is 250, and our average, our current liabilities here, within current liabilities payables are 60 and 50. So the average for them will become 60 plus 50 divided by 2, which will give us the number 55. So if we go to our uh, payable days, so that will be here, which is like our average accounts payable, which is like 60 plus 50 divided by 2, and our cost of goods sold was 250, and to that we divide by 365. So we get the number of 55 divided by 0.7, which gives us 80.3 days. Effectively, it is simply saying that whenever we pay our suppliers, we are taking around 80 days to pay them. So this is your days payable outstanding, or DPO we call it, days payable outstanding. Now, why this is used? If the days payable outstanding is longer, which means you are paying your suppliers at a later point of time, delayed payment, then the company is holding more cash with them. So the more cash is available with the company for their business operations or investment. And if this DPO, days payable outstanding, is like a shorter time, like 10 days, which means that you are paying your suppliers in 10 days. So it's like paying your supplier faster, which means it's building stronger relationship with supplier, but it reduces the liquidity with the company because the company is now having lower cash available with them. Now the supplier relationship and bargaining power also depends on that. So companies with strong bargaining power can negotiate longer payment terms. If you are doing very good, then definitely longer payment terms can be negotiated. And small businesses usually have a short DPO because they lack leverage. Small businesses generally don't have much bargaining power, so they need to pay very quickly to their suppliers. And this also shows the financial indicator that how your business is performing. Now let's see some real world example. So if we see the Walmart case, so Walmart generally have a higher DPO of 170 days to 80 days. Why? Because they pay delay to their suppliers, and their suppliers know that Walmart is such a giant that even if Walmart is delaying the payment, they will do the payment and have a very great long-term business with them. So what happens is like Walmart negotiate long-term credit terms with suppliers. Very long-term credit terms are being done, and letting it sells goods to the customer before paying to the supplier. So what happens? The Walmart purchase the goods, they sell to the customers, get the money, and even after getting the money, they give to their suppliers after 70-80 days. So that gives and makes the Walmart business very efficient, and it strengthens the Walmart's cash position. Amazon also uses similar model. They collect quickly cash from their customers because whenever you are purchasing, Amazon gets the money into their bank account, and but they delays payments to their suppliers because whosoever are the suppliers, Amazon also negotiates them with very hard. And if you are a seller on Amazon, seller also gets paid after 15 days, 20 days, even though Amazon may receive the money on zero date. So basically Amazon also have the advantage in this particular case. If we see the Apple case, so DPO is usually around 90 days because Apple is also strong. It uses strong brand power to negotiate favorable supplier credit terms with other people. But the small retail stores, small shops, they generally have DPO of 20 to 30 days because they don't have much bargaining power, and they have to pay to supplier quickly to get the goods. Otherwise, suppliers won't be giving them the goods.